Hi, this is Brett Hickey, founder and CEO of Star Mountain Capital. I'm excited to be here today with my partner and our Chief Risk Officer, Dr. Lev Borodovsky. Lev, thank you for joining us today.
Thanks, Brett.
Before we get into the presentation here, standard disclaimers. Nothing in this presentation or discussion constitutes an offer to sell or a solicitation of an offer to purchase interests in any investment product. Like to know more information, please reach out to starmountaincapital.com and we will be happy to discuss. Uh, Today we're going to talk about what's going on in the broad economy, starting with the virus and what do we know today. At Star Mountain, we focus on data-driven insights into trying to think about and forecast and make the best decisions we can. So our goal today is to share some of the information that we currently have available, and we want to give it a caveat that a lot of this is unfolding in real time. There's a lot of new information we're constantly gathering, observing, and reviewing. So please ensure that you keep that in mind as we share with you the best information that we have available to us today, and that also we have not been able to independently validate or verify all this information. So keep that in mind that we're sharing information, we're sharing the source of that information, and some of our views on what we're observing and how we're thinking about the virus and how we're thinking about the global economy, and then get a little bit deeper into our views on the U.S. economy in particular, as well as the global lending market and some things to considerate of and thoughtful of as it pertains to the fixed income, private credit investment markets. Star Mountain is a firm. We manage over $1 billion. We are exclusively focused on investing in the U.S. lower middle market. We have two primary ways that we invest into this market. One is by lending money to established private businesses to help them grow their companies through acquisitions and other growth. We also have a complementary strategy, which is focused on providing early liquidity to other investors who are invested in lower middle market funds and or lower middle market investments. And those two strategies are what drives our business to focus on understanding macroeconomic changes as well as what's going on with the economy and these industries, which we'll be discussing today. Myself, I've been investing in the lower middle market for over 15 years. I started covering space nearly 20 years ago at Barney, part of Citigroup Global Investment Banking Group. Lev Borodovsky has been risk officer for nearly 20 years now. Started his part of his career at Credit Suisse, working with Chairman Brian. Credit Suisse's alternatives business at the time. Was his risk officer there, and left having chief risk officer of the GSO team, which was later acquired by Blackstone as their credit business and a strong credit investment firm. Lev also writes a piece for the Wall Street Journal that, if you're familiar with, look at, called The Daily Shot. It pulls the vast amount of information available globally. Lev spends a lot of time breaking that down to very digestible charts and information that helps us think about our business and we think would be beneficial as well. So first off, Lev, let's talk about the virus. What do we know currently? Let's start with the most earliest, I should say, information, which is from China. What can we observe, Lev, in trends based on what we've seen so far in data?
Thanks, Brett. So what we're seeing, and this seems to be the case both in China and South Korea, is the rapid pickup in the number of new cases than peak, and roughly 40 days into the epidemic, it would start to ease, and that seems to be consistent for both China and South Korea. fact, right now in China, they're getting, I don't know, a dozen new cases a day in the whole country. And bulk of those new cases tend to be imported. We're traveling Europe, coming back, and so on. So the number of domestic transmissions is nearly gone, which is pretty impressive.
Especially when you think about that as a, what is it, about a $1.5 billion population roughly?
Yeah, it's some 1.5 billion people, and now a few cases a day is no longer a threat. Obviously people are much more cautious than they were before the epidemic, um, and that keeps social distance and so on. That keeps spread from getting worse. Uh, but so far it's good news.
That's very helpful. Thanks for sharing that, Lev. And I guess as some people, I'm sure it's easy to critique here in the U.S., but one thing that is valuable is that they have, US, I should say, has focused on social distancing and made it a very real thing. And so while I'm sure it's not comfortable for anybody, including ourselves, and it will cause impacts on a number of fronts to a lot of people, hopefully it is the right preventative measures to be taking where we would better, rather be safe than sorry. From a fatality aspect, Lev, what can we learn about fatality rates, whether it's in areas within China or in types of people?
Yeah, the issue initially was, um, all of a sudden you start seeing a lot of people who are sick, and a few who are dying, and so because you didn't know how many people were out there who were sick, it was difficult to establish the mortality rate. And so it looked like, 20% or 10% of people who got tested positive died, and that was a scary sort of start to this whole epidemic. But what they learned is there's just early on there were so many people who were infected that weren't diagnosed and weren't tested. The mortality rate, as they started getting the denominator correctly, started declining, and the numbers, they're still uncertain what the numbers are, but they vary between 1 to 3%, and it's mostly impacting the elderly and sort of compromised immune system or diabetes or some other sort of disorders that make them vulnerable.
That's helpful. Thanks. One of the other pieces of information, Lev, that we've seen that I certainly got some comfort from is thinking about how different temperatures as flus are more prominent during the colder season and how we hope that this virus will be similarly impacted. What can we learn from the data that we've seen to date as far as the potential impact as the temperatures increase?
Yeah, this is a very interesting study that came out last week. Um, the, there was a big question when the epidemic took off in Wuhan, China. People said, well, now we're seeing Thailand, people getting sick in Thailand because a lot of people from China would go to Thailand for vacation, and they brought the virus there. And so start seeing, cases in Thailand, and people thought, well, Bangkok will become the next Wuhan because it has similar population density and so on. And amazingly, only Thailand has, I don't know, 50 cases, 60 cases total. And they couldn't figure out why that is. Now, obviously, Thailand is in a much warmer climate zone. So is it possible that this disorder is seasonal? And as we track this, where you have the big, a lot fast transmission, community transmission cases, it seems to follow this particular temperature zone. And obviously there are cases everywhere else, but the the big epidemics tend to be in zones that are shown in yellow here. And that means if this is really seasonal and obviously hasn't been proven, this is just a hint, but that could be. If it is really seasonal, that means that as we get warmer weather in the U.S., you may ease, that alone may ease the spread of the virus.
That's great. Well, I sit at my home working up in Westchester in New York. I went for a nice run this morning. It was a warm, sunny day, so hopefully on behalf of us all, Mother Nature will do her part and give us a little bit of warmth here and see if that might help. But that's certainly encouraging information to see. Again, a lot of this information is very real time and is evolving, but this is certainly a positive indicator, especially as it pertains to that stress-tested scenario in Bangkok. So some good early indicators there. What can we learn, if anything, as it pertains to the U.S. so far, Lev? Anything that you think is most helpful from an insight perspective for folks?
Yeah, the U.S. is a large country, and obviously seeing the more populated areas getting hit first, partially because there's more transmission, but also some of these areas, particularly bi-coastal areas in Florida, you get a lot more travelers to other countries. People going skiing in Alps and northern Italy and come back with the virus. It's just more common for folks in California to do that. A lot more tourism and so on. And so that's where you had the original flare-ups and the number of cases. But as people sort of stop doing that, I think that, and again, we're looking at potentially the numbers I've heard are, early to middle of next month, of April, we're going to start seeing the number of new cases peaking, and then perhaps declining. By May, we'll start seeing substantial declines in new cases, and people will still be getting sick. It's inevitable, but declines in new cases. So it's I think that's kind of the timing here.
That's very helpful, and certainly we appreciate everybody doing their part from a social distancing and taking other prudent measures. So thank you, everybody. I know certainly all the people we've spoken to are taking this seriously. Again, it's better safe than sorry. So thank you, everyone, for your part. What about vaccinations? That's going to be a critical part of this as it pertains to people getting comfortable long term. What are we seeing currently, and anything we can learn?
Yeah, it's interesting. Obviously this disorder is getting a lot of funding and a lot of interest, and the governments around the world are putting in the sources behind doing some rapid fire research on this. There are two tracks that are taking place right now. One is finding not a cure, but a medication similar to what Tamiflu does for the flu, which is some antiviral that allows you to reduce your symptoms, and that basically somebody gets sick, they're not that the risks of them getting sicker get reduced dramatically from something like that. And again, that gives people comfort, and in particular for the elderly, it gives some comfort there, because if you can halt the symptoms from getting to your lungs and becoming a real problem, something like a Tamiflu version 2 for this will be very helpful. The projections I've heard are, that sometime between late summer and fall, there will be a product like that out there, and that will reduce the the symptoms. That will be very powerful. So they will turn this disease more into a flu than you know, dangerous disorder that it is now. The other track, obviously, is the vaccine, and there's some novel ways that people are approaching it. There are multiple companies in the U.S. working on it. There's a company in Israel. There's a company in Germany and elsewhere, all working on this thing. So one way or another, we will have a vaccine, and timing is you know, by the time you actually get it tested and so on, and make it available, about a year, maybe a little longer. And once you get a vaccine, basically this thing is over. So there's the first trial started, the first vaccine trial started in Washington State, basically last week or early this week, I think they started. There's another one about to start in April. And so we will probably have a dozen running, vaccine trials at any one time. There's an interesting project now that they're using supercomputers to basically look at existing substances out there to actually model, which ones will be the most effective against the virus. And so the technology that exists now to address this crisis is far more advanced than we had during the SARS epidemic, for example, when we had the H1N1 swine flu 10 years ago. So we've made a lot of progress in this.
That's great. So it's helpful to hear that some advancements in technology should also help us find a cure, and that this is also being tackled globally by many countries around the world. So hopefully as humanity all rallies together and takes advantage of modern technology, this is something that we'll be able to tackle a lot faster and a lot more efficiently than historically. And it sounds like a reasonable chance that for the next cold season, where there's a reasonable likelihood that something will be in place, hopefully to potentially reduce, such as a Tamiflu, and maybe even effective vaccination or two. Let's talk about the economy a little bit more, Lev, and why don't we phase in from what we can see in China's economy, which has obviously a high correlation to what we were just talking about in watching the trends of the flu and watching when are people willing to get back traveling, get back on airplanes, be able to get back to work. So that matters as far as we think about the trends of this as we might be observing it in the US, which of course won't exactly be the same, but this is a good data point to observe. And then also that'll flow into forecasts from a GDP growth perspective. First off, what can we learn about following the patterns and the behaviors within China and people getting back to work and so forth?
Sure. It was interesting. It was only China can do what it did, which is take Wuhan, 11 million people, and force them into a quarantine, and then sometime later tell them now it's time to all get out and go back to work. It's not that easy to do in Western countries, but the point is that what they did worked, and it will take some time for the country to get back to normal. But what we're seeing is, if you look at the chart on the left here, all of a sudden you're starting to get more property transactions. People buying homes. You're starting to see, power companies providing more electricity, which is where you see, coal and other types of fuel usage. You start to see a little more traffic congestion, although highways are still pretty light in terms of traffic in major cities. But people are returning to work. It was interesting. Yesterday, we saw, for example, iron ore prices and steel rebar prices rise, which shows that all of a sudden China is starting to demand the product again. So you can see the recovery is basically you had the big drop off around the holidays in China in kind of late January, and then now as we're into March, you're recovering. You're maybe halfway through the recovery, maybe better in some situations. There are people flying, especially on domestic flights, less so on international flights. And so if you look at the chart on the right, what you see is kind of one of the projections for growth, and obviously this quarter is going to be a negative a contraction quarter for China. But economists project that in the second quarter, it will be a rebound, and in the third quarter will be even a faster rebound. And growth, within a year or two, growth will return to its normal path that was originally predicted before the virus came. So you can see that kind of drop.
That's really helpful, Lev. And the other thing I observe here, which we'll hopefully see in the U.S. as well, and your point's well taken, that what China was able to do in halting and getting people back going will not be the same pattern as the U.S., though it is great to see, I believe it's at least great to see, hindsight's always 2020, but seeing the measures that the U.S. has taken to shut down schools, restaurants, large gatherings, and how sports teams and folks of that nature have stood behind this as well and have mobilized quite quickly. So that I think that's probably a real first time for the U.S. to do something in that capacity. And if you look at the gray bars here on the right chart, you see after the drop in Q2, it looks like pent-up demand, hopefully surging a little bit in a Q3, Q4 type of a perspective, and hopefully we'll see something like that in the U.S. as well. It'll be interesting to observe, and we'll keep people posted as far as how things play out in China. Let's shift gears now and bring ourselves more micro from China into the U.S. Lev, what are current forecasts and views on what we might see from a U.S. economic GDP growth perspective over the next few quarters?
Sure. A lot of economists are saying that the U.S. is in a recession currently. And there's debate where the current quarter will come out positive or negative. This particular forecast from Goldman says that the current quarter will be a contraction. Because we're in a bit of a delay from China, the second quarter is where we'll have the biggest impact to the GDP growth, and will be a pretty rough decline in growth across the board, and see sort of areas from manufacturing to consumption, driving this decline. Obviously, consumers are nervous and staying home, and so you'll get this effect. But once that's over and the number of cases starts declining, once we get into sort of summer months, we should start seeing a rebound, and that rebound, it could actually come sooner depending on trajectory of the number of new cases. And once we recover, we will be back to the regular path that people expected we're going to be on. Previously, maybe a little slower growth, just because it will take some time for people to get back into the routine and so on. But I think by next year, we'll expect sort of the normal kind of growth that we've seen earlier. We're not going to have a tremendous growth in the U.S. simply because our labor markets are not growing very quickly. We had some trade tensions that will persist, but we'll return back to normal. This economy is very resilient.
That's helpful. So the current kind of best forecasts, which are never perfect and will always be evolving, is for a pretty hard V-shaped recession, which will impact a broad range of companies. As long as they can push through and survive for the next few months, and few is a big question as to what a few will end up meaning, but then things should come back to hopefully, again, a slow growth type of an economic forecast. So hopefully that'll be a reasonable indicator of what we see. What about a difference as we think about the last recession and we look to this recession? Let's talk about the banks and the role they played and talk about the health of the banks, where they were at in the last recession and where they're at now as we see the banks are in a much healthier position. Talk to us a little bit about that, Lev, from a few data points, and then also how you think that can benefit this recession and potential recovery.
Sure. So the banking system is dramatically stronger than it was in 2007. There are multiple reasons for that, but the biggest reason is, the Fed instituted and the OCC instituted a number of policies after the financial crisis to strengthen the financial system in the United States. And these programs included anything from lowering dependence on short-term financing to boosting capital ratios. I think the key effort from the Fed that is, I think, has been very effective is the stress tests. So every year the Fed takes the banking system and says, okay, guys, here's a new set of scenarios. We want you to apply those scenarios to your loan books, your portfolios, and those could include default scenarios, like rising unemployment and so on. And want to see how well you do under those shocks. And depending on the outcome of those shocks, we will allow you to pay dividends. If you fail those tests, you cannot pay out dividends. You have to boost your capital. And that approach basically forced some banks, and some did it voluntarily. Folks like J.P. Morgan basically boosted their capital base on their own, and so you have a healthy financial system going into the crisis. And the types of stress tests that the Fed had banks run resemble exactly what's happening now, right? And we know that they should do reasonably well. That's not to say that we won't have some small banks that are concentrated. Have a bank that may be lending to the oil industry in a particular community. They may have some troubles because oil prices today dropped to lowest level in 18 years, and so some sectors will have trouble, like the energy sector, and banks lending into that sector may have concentrations, may run into some trouble. But those tend to be regional, more community banks. The big banks, that's where the big concerns are in much better health and are very diversified.
That's great. Well, that's helpful. And then I guess ultimately the benefit there is if banks are in a lot better shape with better liquidity and availability to invest, that they should be able to continue to hopefully provide capital for purchasing real estate, for other type of business. And banks, of course, have changed a lot in what they do over the last 10, 12 years, and their role in the lending environment, which has partially been filled by different alternative lenders, but it's very positive nonetheless that the banks should be in a position to be much more helpful to, in effect, stimulate and keep economic activity growing. Is that a fair assumption, Lev?
Yeah, I mean, think about the situation that occurred in 2008. People with payroll, right? Let's say you're a small business, you got some payroll. Let's say you got $1 million in payroll, and you kept it at some bank. All of a sudden, you don't know if that bank is going to go under, you're going to lose your payroll. You won't be able to pay people, right? And so those are the types of concerns people had, and they needed the government to step in and protect that, right? Those concerns really don't exist anymore at this point, and so there's just a lot more confidence that you can deposit money with your bank and not worry about severe problems. And obviously credit. I think obviously banks will pull back and be a lot more cautious, but they will provide credit card financing. They'll provide mortgage financing. They'll provide some small business financing. Credit lines in particular for businesses are really important because everybody's tapping their credit lines right now to get through this period.
That's great. So that increased liquidity should be very helpful. It's a good data point I thought worth us mentioning. Another data point as it pertains to banks, as is referred to the big U.S. banks, which are the sixth largest banks in the country. What do we observe there as we've seen their kind of current status?
Yeah, so these are the banks, in addition to some other institutions that the Fed classified as systemically important institutions. And so they had there were extra requirements put on these banks to make sure that they're solvent, their liquidity ratios and so on. And so if you compare these banks to the way they were in '07, it's a completely different situation. Um, so relative to where the Fed needs these banks to be capitalized, they're all significantly overcapitalized, and yes, these capital ratios will decline through this period, but that's what they're there for, and so if you just look at the largest banks, they're in good shape relative to where the Fed wants them to be.
That's great. So they can afford to absorb some shock, whereas heading into the last recession, they really didn't have much much of a shock absorber left in them.
Yeah, there will be some loan losses. There will be some loss of new business. There will be loss of revenue because fewer people may decide to borrow. But nevertheless, they should do okay. One interesting development that just happened in the last few days, and that is as the Fed lowered rates dramatically to zero, right? The yield curve has steepened, and that's good news for banks because they can basically borrow money. Banks can borrow money for free, right? And with a steep yield curve, they can lend money 2 years out, or even 1 year out at a higher rate, right? And so all of a sudden, that boosts their margin, that net margin, interest margin, which is really a positive development. The steeper yield curve is very helpful for them because the yield curve
allows the bank to have make their loans in a lot more profitable manner between where they borrow and where they lend at. Yeah, that's a great observation. As we look now, let's now do a little bit of comparison globally. As we know, the world is more globalized, but as we think about the U.S. on a relative basis to other countries, A, as we compare the U.S. to other countries, and then B, as we think about the U.S. in this current recession compared to the last recession, 2008, what can we learn about the U.S. consumers? It appears that they're in a much better shape, which should bode well for the U.S. Economic recovery. What are your thoughts on this?
Yeah, and that's another development that's unique to this last recovery. That is the household leverage, which is debt to disposable income, has declined substantially in over the decade, and there are multiple reasons for it. Incomes obviously have gone up, but the consumer has been unlike in previous sort of growth periods. This decade, the consumer has been relatively conservative, and I know people, how can they be? Look at all the credit card debt that's growing. Well, yes, there's more credit card debt, there's more auto loan debt, there's more student debt out there, but people are also making more money, and the population has grown, and so on a ratio basis, the leverage, which is, if you think of household debt to disposable income, is substantially lower in the United States than it was, a decade ago, 2008, which will cushion the consumer. If you look at it relative to some other countries like Canada, where real estate borrowing boosted consumer debt, consumer leverage quite a bit, Australia and places like that. That didn't really happen in the United States. I mean, people were a little shell-shocked after the financial crisis, and people were conservative. Home equity loans, for example, are not very popular. People were very careful how they use home equity loans. And so the consumer in general is in very good shape. Again, that's not to say that we're not going to have an increase in delinquencies. We will, right? People will lose their jobs, and there will be liquid on debt and so on. And we expect that in every recession. But relative to other countries and relative to what we saw in 2007, I think the consumer is in much better shape.
Also a good data point that even with the temptation to borrow with so much lower rates, that the U.S. consumer on average, at least on this metric, has stayed more prudent. That's a helpful indicator for the U.S. economy. As we look at the U.S. now, a recent research piece by David Costin at Goldman Sachs talked about how they believe that companies that have more of their revenues driven from the U.S. should recover faster because the U.S. as consumer, as we talked about, is in a lot better shape and is a bigger country and a lot more independent to grow out of this recession. Another data point as we think about the U.S.'s reliance globally, what do you think about the U.S.'s position on a relative basis to other countries as far as places like Germany that sold a lot of their cars to China, for example, as China's growth slows? How do you think about the U.S.'s ability to recover relative to other countries?
It's interesting. The U.S. Is one of the least reliant countries on foreign demand, right? If foreign demand slows, it obviously impacts us, impacts our manufacturers and exporters. But relative to the overall GDP, it's really considerably lower than our peers, than the other developed economies. And you mentioned, Brett, Germany. Again, it's a heavily reliant economy on exports, which was great when China was booming. Germany was booming as well. But it'll be a while before the Chinese will buy Mercedes in big numbers again, right? It'll take a while for them to recover. And so Germany is dependent not only on issues, covering their own domestic demand, but also on other countries, big time. So their economies is dependent on that. The U.S. is not. So in the U.S., once the consumer returns, once domestic business activity returns, even if the rest of the world is still struggling, the U.S. will rebound. And you can see that the chart showing that the U.S. exports are only 12% of the GDP, relative to, say, Germany is 47, or South Korea is 44%. That's a significant difference.
It seems like politically there's a demand to have even more manufactured in the U.S., not to get into politics, but certainly that's something that we see a push for, and
and that will probably happen more now, because a lot of companies who were relied on outsourcing got burned two ways. They got burned through the tariffs, and they got burned through this current crisis, through supply chain issues. And so a lot of companies will be rethinking in the next couple of years how they do this business, and probably A, they will diversify their supply chains, and B, whatever they can will come back to the U.S.
One thing for people to think about as they're doing their research and analysis on companies and investment strategies is looking through to see for the businesses they're looking to invest in, how much of their revenue might be driven from other countries and how much those countries might generically, or generally I should say, be slowing down and potentially have a slower recovery is something that's probably helpful for people to keep an eye out for. As that transitions, let's talk a little bit about different risks and mitigants in the market in general. And let's start with a high-level, broad industry view. This is a chart here from Moody's talking about different levels of risk. What are some of the insights you think, Lev, are most helpful for people to be aware of as they think about different industries that might have the biggest impact from the current virus and have potentially the hardest time recovering as a result of it?
Sure. I mean, the stock market can kind of tell us a bit about what those trends are. The stock market is a forward-looking indicator. You can see, for example, companies that are struggling in the stock market versus companies that are doing relatively well. So, Kimberly-Clark is outperforming other companies. Why? Because they manufacture paper towels and toilet paper and so on. At the same time, airlines and cruise lines are struggling. So the stock market kind of tells you where the risks are. But this particular chart gives you kind of a general overview, and some of these shocks will be short term, and some will be longer term. So you look at the high exposure, things like apparel, auto manufacturers, consumer durables will get hit for sure. But people are going to need to buy washing machines, and they're going to need to buy cars, and they're going to need to buy clothing. So that should come back reasonably quickly. On the other hand, something like gaming may take longer before people are comfortable enough to get on a plane and go to Vegas.
There'll be some good deals in Vegas coming through, I imagine.
Exactly, right. Right. Similar to when you look at on the right side, we have lodging and leisure and tourism. That's an industry that's going to be having a little bit of a longer term recovery before people come back. But look at airlines. Yeah, casual flying is probably being slow. Business flying will return pretty soon, as it did in China. Retail, it's people will be buying more from the internet. Some of that trend in retail is a structural trend. This epidemic will just accelerate what's happening in that trend, which is companies moving more and more of their business online. So you have fewer physical stores and more, and this trend will just continue, maybe at a faster clip. And you'll have like things, international issues like global shipping. Again, that's a business that's dependent on the rest of the world and demand globally. So it will vary, right? Depending on the industry, the impact and the longevity of the impact will vary on kind of demand recovery.
I think that's a good distinction to make, is that there are some things that will have a short-term hit, but then they will likely come back relatively quickly. There are other things that are trends, that those trends may escalate. As we've invested in certain industries, telehealth, video conferencing, things of that nature, we're seeing obviously increased trends on that. And so good for people to be mindful of how this might impact the changes in consumer behavior generally. As you mentioned, people buying things online. Is that going to continue to systematically increase, and who may be the beneficiaries of that, and who may be the people that are challenged from that? So thanks, Lev, for that. As we think about some of the other things that will impact, in particular, short-term risks. They obviously impact long-term risks, but one of the things that I think is really helpful for people to think about are what are the risks of default? And Moody's did a 25-year study and looking at predictors of default. And of course, no one piece of information is ever perfect, but this is a good data point. And the key takeaway here is that leverage is the largest determinant of risk. The size of a company matters, but ultimately is the smallest determinant of risk. The other piece of information that we found very helpful is that if you take the amount of leverage, you take the liquidity a business has, and if you have a lot of debt, you probably have a lot of stress on your liquidity. And then if you go over to the fourth column, to the debt coverage ratio, the more debt you have, the less debt coverage you have. So you have 60% roughly of the variables. They're all highly correlated to how much leverage you have on your business. And as we think back to some of these shorter term risks, there are some businesses that have prudent balance sheets, that have a good amount of liquidity, that have a good amount of extra cash, and they can weather these storms. There are other businesses where this may be a very difficult time for them. In fact, it will be a difficult time for them, and some businesses may go all the way through into bankruptcy, from this, because it's going to be a shock measured in at least probably a couple of months, potentially longer, that businesses will have to need to survive and operate and manage through, potentially without being able to access much other capital. Although, as Lev pointed out, it is helpful the shape that the U.S. banks are in particular. That's not an exact replica of what's going on in banks in Europe and other markets, just for sake of clarity, which we won't get into today, but there are pretty meaningful differences in banking systems. Another interesting fact from this current market environment is valuations. So the average purchase price multiple that private equity firms and other folks have paid for companies in 2019 was at a slight all-time high at 12.9 times to the far left bar on average. And if we also look at the dark blue, which is the amount of leverage that the company had to use to make the acquisition at the time, on 2008, we can see that that was approximately the highest. Technically, the data in 2014 shows that it jumped up to 7.2 times. But if we compare 2008 to 2019, we can see that the valuations at the private equity side are a little bit higher now than they were then. Leverage seems to have been quite a bit higher in 2008 than 2019. And so that gives some people comfort. However, if we drill down deeper and look into, as we've all heard, the devil is often in the detail, as we think about a key variable here is how do you define EBITDA? Stands for earnings before interest, tax, depreciation, amortization. But there's often a lot of variability in how a lender or private equity firm will calculate what are things that are a one-time cost that are not included in that EBITDA that ultimately gives a higher EBITDA. For example, businesses might say, I'm opening a new store. Please don't assume that my expenses are higher right now. Assume that this store is open, functioning, running, and generating real cash flows, and incorporate that into my run rate forward-looking EBITDA. And so some valuations and some leverage multiples may have large things that ultimately mean that it's assuming the EBITDA is much higher than it actually is. Some of those adjustments may be legitimate and warranted. Some of them may have a lower probability of occurring, particularly now as we've hit a challenge in the market. So if you were assuming you were opening new gyms or new restaurants, that is likely on pause for quite a while your expenses may still be running and your revenue's low, which can of course cause some major challenges and concerns. That is one of the things that does give us some concern within the economy, where there's a lot of additional detail that's not within face value shown information. To the far left, this is information from Lincoln International as a large valuation firm, and they looked at the average EBIT adjustments in 2013 and compared them to 2019, and the reason for those years was just really when they started collecting much more granular data, and one of the reasons that led them to do that is they viewed that EBITDA adjustments were systematically increasing. That means, in simple terms, that the valuations and leverage are really, leverage is higher than it might seem. Valuations were higher than they might have seemed on a historical EBITDA perspective and valuation. 2019 on average, Lincoln came up with 24.7%, so approximately 25% was the average adjustment to actual EBITDA. So if we look to the right and we assume, which probably wasn't exactly true, but let's assume that in 2008 that it was an actual EBITDA leverage multiple on average of 7 times. And we look today and we say, well, it's only 5.9, so it's not as bad. But with a 25% adjustment to EBITDA, that adds another effectively 1.9 times worth of leverage, which, as you can see in the top right of that column, means that your actual EBITDA leverage ratio may be 7.8 times today. So that would in fact be an all-time high leverage ratio, but more relevantly, it's a big factor. It's not a small number that we'll see how that plays through this current economic downturn. Another change in the credit markets to be wary of, and we've all seen this and heard of it, so it's nothing new, but we did want to re-highlight this, is that covenant-light loans, meaning that loans made that have very friendly terms for the borrowers, are at all-time highs. And based on this data from Standard & Poor's, as of the end of 2018, they found that approximately 80% of all the loans issued were covenant light. That means that the lenders have a lot less protection to impact what a business does if there are challenges. So if a business is starting to not perform, and historically it would breach a covenant, so it would be out of compliance, then the lender would have the ability to step in and help direct what was going to happen and help have a seat at the table to help protect their debt capital. In the current state of affairs, a lot of those protections that were afforded to lenders have materially gone away. So that is going to be an interesting observation to see how that impacts the global lending market as a change. Another thing some folks have asked us to talk about today is a bit of a thoughtfulness through different aspects of risk to consider, which there are of course many, and this is only a few of. As we think from a top-down perspective, if people are investing in fixed income lending products, the first thing is looking, does that fund itself have much leverage? So the CLO market, collateralized loan obligations, are typically a product that has a lot of leverage at the fund level. The second is company level leverage, which we just talked about. Then there are the EBITDA adjustments, which require the capability to get information, analyze it, interpret it to determine what the real leverage levels might actually be. Then there are the loan covenants to help protect the lenders should there be challenged market environments as we're seeing today. The next is loan ownership. Loan ownership means how many people actually control the voting of the loan. So if there is a challenge that a company has and the lenders need to say, how do we deal with this challenge? Do we extend them more money? Do we reduce their interest rate? Do we give them some holidays on interest to make up for it later? What do we do about it? Do we call the loan and do we tell them they need to repay it? There are a lot of different things that that lenders need to consider. If you have a large group of people that have diverging interests and are harder to get together to make decisions, that complexity can also have challenges and can create additional risks. Then you get into, if there are those risks, what is the ability of an investment manager? What is their capability to manage challenges and work through those challenges, as people call workouts? And then lastly, what are the various sources of repayment? Depends on what type of a business you're lending to. Do they still have good cash flows? Do they have assets you might be able to liquidate? Is this a short-term challenge you can work through? Or is this going to be something long and systematic that ultimately you're going to need to look to get repaid in different ways, including potentially selling the business? So those are some of the risk factors that we think about as a business and that we think are helpful to share. Thank you, everybody, for your time. Lev, thanks for your time going through this. We will continue to keep people updated with different information that we see around the virus and continue to communicate with you all. We hope that this virus does get tackled in a swift and prompt manner, and we wish you all health and safety.